Absa Asset Management was established in 1997 and now boasts over 100 billion rand in assets, and that spans equity, fixed income and property asset classes. The division now competes head-on with the country's older and more established asset managers, as well as a few divisions within the Absa Group. Busisa Jia was recently appointed to the role of Managing Director, and he joins us in studio to give us the lay of the competitive landscape now that you're in that heavyweight space. How are you feeling about the competitive environment right now, Busisa?
I'm feeling confident. We have in excess of 115 billion assets under management. We have a fairly small team, but we manage on a house view perspective. So the most interesting thing is to get everyone's input in terms of what represents us as a house, and we provide the value to our clients.
So, Busisa, just to put that into context, we've seen some of your competitors like Investec Asset Management. They allow a sort of multi-strategy approach. Others pursue a sort of single investment approach with regards to the assets they manage. When you talk about house view, are you talking about each respective portfolio manager pursuing their own strategy and having a core holding, or how does the house view actually work?
Okay, so we are represented across the major asset classes, as you said earlier, in terms of equities, domestic property, domestic bonds, and domestic cash. We also have multi-asset class funds in the form of absolute and also balanced. In each of these asset classes, we will have a single house view, and that house view will be represented by a portfolio manager that collectively represents the house portfolio of that particular asset class.
Okay, so it's a
so we don't have small caps. We don't run themes where you have a small cap or value or growth. We are a pragmatic value house. All our benchmarks are rolling 3-year periods, and we really compete against that benchmark as opposed to focusing on the peer group, because when you focus on the peer group, you tend to watch what others are doing instead of keeping to the discipline of managing on behalf of your clients.
It's a challenge that businesses across the board face, and that is the attracting and retaining of talent. Is it high on your agenda? What are you doing differently to other houses out there?
It's very high on our agenda. I think just like our competitors, it's a brain game. It's about attracting the right kind of talent and allowing for that talent to learn your house view in terms of how you interpret the market and how you invest, and ensuring that their input is valued in the contribution of how you represent yourself as a house. And like our competitors, we are always on the outlook to find new talent, and we work hard to keep our colleagues happy in the jobs that they do. But it's really a difficult profession. But it's one that I think is more like a calling. I think if you are a portfolio manager or an analyst, it's in your bloodstream. It's something that you live with every single day.
What about the threat of passive strategies to an active manager? That's got to be something, again, that is a very real threat in the current environment when not many active managers are outperforming the benchmarks.
I think the immediate concern for an asset manager that's new, and we are relatively young, is that you have a critical mass of assets under management that allows you to be profitable in a sustainable way as a business, because after all, it is a business. And beyond that, you have to stick to your knitting. It's important that you focus on your own key strengths. At no point do I present the idea, or the house presents the idea, of passive against active, or multi-manager versus single manager. Our client base typically is a retirement fund that is advised by an asset consultant or actuary. They will have developed an investment strategy, and by the time they put out to tender assets to be managed, they are already clear whether they want a passive or an active manager. It's a rare case, and in the year that I have been at Absa Asset Management and in my career of 16 years, that I have ever tendered against a passive manager. I think the fees is an ongoing debate where, as a house, we wish to be competitive. And obviously the fees will be based on a sliding scale and negotiated with the client. The reality is, as a active manager, you are actively trying to beat the benchmark over a long-term period, not over 12 months. And as I said to you, our benchmarks are rolling 3-year periods and beyond. And a person who's looking for alpha is looking for an active manager.
Basisa, just to talk about that for a little while, just in terms of being able to achieve alpha, do you think there are definitely periods where active managers do better than the index, or do much better than other periods in a market? And if that's the case, what sort of market are we in at the moment?
I can only really speak on behalf of Absa Asset Management, and I would say yes, over a long-term period, an active manager will outperform a passive manager. By that, really, the passive manager is buying the benchmark or buying the index and tracking it. And the way you manage a portfolio in our value proposition is that we are a fundamental house. So we will meet management, we will have a firm understanding of the company. Most of our analysts and portfolio managers are chartered accountants and chartered financial analysts, so we will spend time with the figures, spend time with the manager of that business, and then go through evaluation. So my view is that it's different for each client. There are clients that are looking for a core solution where they want it passive, and there will be that component. But it's a rare case where you have a client that only wishes to have passive management. And there are periods in our experience, if you look at our track record, especially in domestic equity, where the power of compounding shows the longer the period that you've managed. So despite the fact that for one year period or 2-year period, it may look like you're only outperforming by 1.5% or 3%, over a long-term period, there's an exponential difference between the benchmark and
how is
and your
the
fund.
game plan for Absa Asset Management going to change under your stewardship?
Well, I think that as I alluded earlier, we wish to have representation in every major asset class domestically. So equities, property, cash, bonds, and then a combination of that in terms of domestic balance mandates. That includes absolute. We wish also to be in the space of global, in the new definition that used to be international, and have an equal representation across the major asset classes, so equities, bonds, and multi currencies, and Africa. So what is outstanding in our suite, in our offering, is working on developing strategies for Africa. And the first asset class within Africa would be listed equity. I think the key difference there will be that it will be a true Africa equity fund, in that it includes North Africa, which should address the ongoing debate that people have around the liquidity of listed equity across Africa, in that it would include Tunisia, Morocco, and Egypt. And then we will work across an Africa bond strategy, but it would be across the major asset classes.
Do you feel that you're late to market in Africa?
I don't think we're late. Africa's the origin of mankind, and I think that the opportunities that people see in the space in the last 3 years have been there for over a decade. If you were invested in the major stock exchanges across Africa and you had access to them, then you would have also benefited in the growth and returns that have been there. So we will learn from the mistakes of our competitors, and I think that in Absa Asset Management, we have the advantage of my having been the managing director of Thomson Reuters across Africa. So I've worked across Africa for a period of time, and I know the environment, and I think that we are not too late. We are behind, but we will use that to advantage in learning from our competitors and make sure we launch a value proposition that has a long-term benefit to our clients.
Just in terms of the Barclays and Absa Asset Management, we've seen that we've seen what's happening in Africa with now Barclays reporting, while staying branded. Barclays banks in Africa are going to report into Absa. Are you, in terms of asset management, have you got any plans to expand into the continent like some of your peers that include Stanlib are doing at this point, or is it very much going to be South Africa as the base, and that's the only country that you're going to extend your investment products to at this point?
I think it's a safe assumption that we will expand into Africa. We have a motto within Absa of saying one Absa, one Africa, and certainly the benefit of having Barclays offices scattered across Africa gives us an advantage of heritage and knowledge of our client base across Africa, and we will use that to our advantage. I think it's become apparently clear to our competitors and the wider world that if you are going to participate in Africa, you need to have roots in Africa. And so whilst the base of our expansion will be in Johannesburg as it is today, we already have existing offices through Barclays across Africa, and we will use that to our benefit in our ability logistically to analyze stocks when we launch a listed equity Africa fund. And I think there's every intention to use it as an advantage.
Just in terms of the branding, and this talks both to Africa and to locally in South Africa. You're part of a bigger group. You've up against, as I say, very older and more established brands in the marketplace. How do you go about developing the brand locally under the umbrella of Absa? And how do you plan to grow the brand into Africa? Will that also be under the Absa name, or will that be a joint Barclays Absa branded product?
I can't answer on the group strategy. My rank doesn't rank that high. Only to say to you that we will use our advantage in Barclays and Absa, and it makes sense to make that consideration in the future. Obviously, as an asset manager within a commercial bank, most commercial banks will have an asset manager where the key business in the past has been retail and business banking, where the most recent reputations have been centered around corporate investment banking. So asset management has its place in its model as a business, so long as you have clients and those assets on board and you manage and you have great performance and administer for your clients, so you charge a fee. So every year you don't start from scratch. Your client base are typically retirement funds that are perpetual funds. So as long as you keep performance strong and those clients are happy with that performance in perpetuity, so you can manage those clients unless they change their strategy. So I think there is a clear value proposition of having an asset manager within a commercial bank, and I think that we will play our role. But as you know, in business, you have to prove yourself before you are relied on and depended on, and we have grown our assets under management tremendously, especially in the last year, and our performance is strong. So the key challenge into the future is to maintain that performance and keep on attracting assets under management.